Hello, everybody. Welcome and thank you for joining me today. For those of you who I haven't had the opportunity to meet, my name is Matt Landon. I am the CEO of Semmax Financial Group. And today we are going to get into the Q1 2026 quarterly client webinar. This is our first look at the markets in 2026, and we're going to talk about what it could mean for your family's wealth in the months coming up ahead. I've got my coffee. I hope you've got yours. I'm excited. So let's jump right in. So today we're going to be discussing several market kind of moving topics and how they're going to impact your portfolio in the coming months. You see, I've got them headlined here. Right off the bat, I'm going to do a quick market recap. We'll talk through some corporate earnings, touch base on the stock market, also international markets. We're going to talk about valuation monitor. We're also going to get into some economics data, what we have and what we don't have. We're going to discuss the labor market, just a little bit on interest rates, the long-term perspective, and then looking ahead, some key themes that we want to watch for in the next 6 months. So if you're ready, let's buckle up and get started. Right off the bat, this is pretty interesting. This is our market recap. Now, this slide graphs the S&P 500 during Q4 and overlays major economic and political events. Here are the main takeaways. The fourth quarter opened up on a pretty cautious note. If you remember back in October, I know we've gotten through the holidays, it's been a while, but all the way back on October 1st, the US government entered what was going to become a 43-day shutdown. This was the longest in history. Early on, the markets treated the shutdown as political noise, but the delay of economic data, it really became a theme pretty quickly, with the Fed officials warning that the data gap was complicating their policy outlook. That increased uncertainty. Around the same time, stocks sold off as the Trump administration threatened new tariffs and trade tensions kind of flared up again. A week later, there were several bankruptcies in the auto sector, and then there was also some fraud-linked loan losses at some regional banks, which raised concerns about credit quality. This was in different parts of the financial system. So those headlines really pushed the S&P 500 index lower, but the index rebounded later in October as those trade tensions and kind of eased. Credit fears kind of calmed down a little bit. Now, in the background, the Federal Reserve was again a major news story in Q4. So the Fed was following up on its September rate cut with a second consecutive rate cut of 0.25%. That was done in late October, and the market was nearly certain the federal bank was going to cut again in December. However, that confidence started to fade in November as the Fed officials were pushing back against the need for a December rate cut due to the economic data blackout. Now, stocks were trading lower as the possibility of a December rate cut fell to about 40% in late November, but it rebounded as the shutdown ended and restored the flow of data that the Fed relies on. So the markets ended the year strong despite Q4 cross currents and kind of a shaky start. NVIDIA's late November earnings once again signaled strong AI infrastructure demand that reignited this AI trade. And the Fed followed through with December having another 0.25% rate cut. Now, there were mixed messages on the economy, and the release of economic data resumed right as the shutdown ended. The delayed jobs report showed the unemployment rate rose to a 4-year high of 4.6%. And that led to concerns around the labor market. But the delayed Q3 GDP report showed that the U.S. economy it actually grew to 4.3%. And that was the fastest pace since 2023. So the S&P 500 ended the year at a near all-time high. It was supported by the easier Fed policy, resilient economic growth, and strength in AI stocks. We're going to explore these themes and their implications for the portfolios in the rest of the webinar. So I hope you're excited. I love this kind of stuff, and I think you'll find it fun too. So let's jump in. When you look at this next graph here, this is corporate earnings. So this is highlights the fundamentals behind the S&P 500's performance. So the chart on the left is graphing the S&P 500, the next 12 months price to earning ratio. This is a measure of how much investors are paying for forecasted earnings over the next year. So you think about the multiple, it remains elevated at nearly 22 times. That's near levels seen in the immediate post-pandemic recovery, and it's the highest since the late 1990s. The current multiple reflects a couple things. But one of the big ones it does is it reflects investor confidence in the stock market and the economy, but it also raises concerns about the potential for future gains. With valuations already near record highs, the stock market is increasingly reliant on strong earnings growth to justify these stretched valuations. So the chart on the right graphs the year-over-year growth of the S&P 500's quarterly earnings per share. This helps explain why investors have been willing to pay a valuation premium. Q3 marked the fourth consecutive quarter of double-digit earnings growth and the ninth consecutive quarter of growth. Companies have delivered solid results despite a volatile background of shifting trade policy, persistent inflation, and uneven consumer demand. I mean, you've got a combination of cross control, pricing power, stock buybacks, robust earnings growth at leading AI companies that has all supported corporate profitability. Now, the charts show a market that's trading at a meaningful valuation premium that's relative to history, but this is one that's supported by solid earnings growth. Now, Wall Street analysts are forecasting continued earnings growth in 2026, and that's helped the market continue to set new highs despite these stretched valuations. So, with stocks trading at a premium valuation, earnings are going to play an even more important role in shaping that market performance next year. So, when we look here, this is giving you context about a stock market trend that's defined the past 3 years. It graphs the percentage of S&P 500 companies that have outperformed the broader index. A higher reading indicates more companies outperforming the index. A lower reading indicates fewer companies outperforming the index. Now, on average, 49% of S&P 500 companies have outperformed the index every year since 2020. Starting on the right in the early 2000s, that stands out as a period of really strong market breadth, with over 60% of companies consistently outperforming the index. These years were well above the average, and it likely reflected some of the aftermath of the dot-com bubble when the largest tech companies weighed on the index. So these really big tech companies were really pulling down the index, while most companies were less impacted by the busting of that dot-com bubble. The share of outperforming companies has generally fluctuated from 40 to 50% going back to 2007, with occasional periods of stronger and weaker breadth. However, the past couple years look very different. Now, these readings coincide with the rapid rise of the AI industry. So this has fueled strong gains in the small set of mega cap firms such as NVIDIA, Amazon, Alphabet, Microsoft, Google. These are the companies that have had the biggest weights in the index, which means their strong returns pull the index higher, making it more difficult for smaller companies to keep up. The chart also underscores how a concentrated group of tech stocks has been responsible for a lot of the S&P 500's recent strength. This is also highlighting narrow market leadership, and frankly, it raises some concerns about the market's resilience on a handful of firms to generate returns. The AI industry, and by extension, the AI thematic trade in the stock market, is now entering its fourth year. As the prior page showed, valuations are elevated. So there's debate about how much further AI trade can pull markets higher, and investors want to see more companies starting to keep pace with the index. So one of 2025's defining themes, okay, this was the outperformance of international stocks over US stocks. This slide here is graphing the annual price return gap between international and US stocks going back to 2006. Positive values indicate international stocks outperformed. Negative values indicate US stocks outperformed. So this isn't necessarily gain or lost money. It just has to do with who performed. Now, what you'll notice right here is in 2025, those international markets, they outperformed the US large cap by the widest margin going back to 2009. So what you see here is that international stocks have consistently underperformed since 2009, with only 4 years of outperformance in the past 16 years. Between 2010 and 2024, US stocks outperformed international stocks by over 350%. I don't know if you recall, but I've been saying this in a lot of meetings. I've been saying it for a few years. I think I first said this 5-6 years ago. I said it's not that I have a problem with anything international, but when it comes to investing, I was chanting USA number one and waving a giant American flag. We've really seen that borne out. However, when you look at the US economy, it grew at a stronger pace in the post-2008 financial crisis period, especially compared to regions like Europe. Second, international indices have had limited exposure to leading US tech companies like NVIDIA, Amazon, Microsoft, and this has all benefited from the increased tech investment and the rise of the AI industry. Third, the US dollar strengthened against a wide range of international currencies over the past 15 years. That's been driven by the US's stronger growth, the dominance of US tech companies, and higher relative interest rates. So this long-running trend really had a shift in 2025, with international stocks outperforming US stocks by over 10%. This was their second strongest year since 2009. I want to be very clear about something. This was not a case of US weakness, okay? US stocks rose nearly 18%. This is more so a case of international strength. Those international companies gained over 30%. Now, several themes contributed to this international outperformance past year. Most notably would be shifts in the US trade policy, including new tariffs. This triggered multiple ripple effects across global markets. The resulting uncertainty led investors to decrease their exposure to US stocks. This contributed to a weaker US dollar. This increased US policy uncertainty also led to foreign governments to pass fiscal spending bills, signaling stronger economic growth outside of the US. You notice President Trump, he put some pressure on NATO. They've started increasing their defense spending. Well, what did they do? They did that with their own companies. You see this driving up. Finally, these international stocks entered 2025 trading at a significant discount to US stocks after years upon years of underperformance, making them a relative value opportunity. Now, one year does not necessarily signal a trend reversal. 2025 could mark the start of a shift towards a more balanced global equity leadership. Excuse me. Investors are watching closely to see if the international momentum continues into 2026. So let's take a big picture view across asset classes. Okay. The chart is showing the current percentile ranking of various market data points, including asset prices, valuations, and financial conditions compared to the last 20 years. I know that's really exciting. Excuse me. Each bar in this chart represents whether today's value of a specific index, commodity, or market metric stands in relation to its own 2-decade history, with 100% indicating the highest point in that period. Okay? What the heck does that mean? Okay, I'm going to say it again. Each bar represents where today's value of a specific index, commodity, or market metric stands in relation to its own 2-year history. 2-decade history, with 100% indicating the highest point in that period. The data spans the US and the international equities, US sectors, commodities, credit spreads, and the VIX, which is a measure of market volatility. We're going to start on the left-hand side of the chart. Now, this is covering US equities, sectors, and international equities. The S&P 500 trades at nearly 22 its next 12 earnings estimate, placing it above the 90th percentile. This aligns with the previous slide that discussed market equity fundamentals, and it really confirms the importance of earnings growth in 2026. The next couple bars are showing you the S&P 500, you see the NASDAQ, the Russell 2000. All of these are trading close to their 100th percentile, meaning they're near 20-year highs. The next two bars show the industrial and financial sectors trading in the 98th percentile, highlighting that cyclical sectors, they're also trading at or near all-time highs. The international bar shows that the trend is not confined to the US, and you see that foreign stocks are trading at their 100th percentile and near new record highs as well. Towards the right of the chart, gold and silver prices rank in the 100th percentile, sitting near all-time highs. The two short bars graph corporate investment grade and high yield credit spreads. The IG credit spread is at the 0 percentile, and the high yield spread sits at the 3rd percentile. Both of these are near historic lows. Just as a reminder, tight spreads signal low perceived credit risk, and that's an indication that investors aren't getting much extra yield for taking additional credit risk. On the far right, the VIX, which measures market volatility, sits at the 32nd percentile, and that's signaling a below average expected volatility relative to the next 2 decades. I say that, but at the same time, I kind of feel like the VIX gets really volatile up and down like everything else, so bear that with a grain of salt. This backdrop of high stock and commodity prices, tight credit spreads, and subdued volatility, it's really a unique mixture of asset class pricing. It shows that today's markets are priced at extremes across asset classes and the starting point of one relatively full valuations and calm conditions. This doesn't necessarily mean sell everything or that a crash is imminent, but it does have practical implications. Okay. This is a time to one, stay diversified, two, avoid chasing what's working best recently, and three, ensure your portfolios are diversified and aligned with your time horizon and your risk tolerance. So when I say stay diversified, uh, you can look at it in a couple of different ways. One of them is across sectors, another one is across asset classes, and then a third one is across just broadly risk profiles. So you want to be diversified in a number of different facets. And then I think geopolitical concerns are something that we're going to touch on here at the end as well. And so you want to make sure that you're not overly concentrated in that regard either. So key talking points. This provides you an update on the U.S. economy as we start 2026. This is graphing quarterly GDP growth from Q1 2016 all the way to Q3 2025. That is the most recent quarter that we actually have data available for. So our focus is going to start on the middle of the chart, right around the pandemic in 2020. You can see the sharp contraction during the pandemic, followed by a strong rebound that carried into 2021 as the economy reopened. So growth slowed in 2022 as the Fed were aggressively hiking rates, and then they settled into a more typical 2 to 3% range in 2023 and 2024. There were a couple soft patches, but the broader post-pandemic period was one of steady expansion and solid growth. 2025 was noticeably more volatile. GDP turned negative in Q1. This was primarily due to companies front-loading imports to beat tariffs and consumers slowing their spending. However, growth rebounded to 3.8% in Q2 and accelerated to 4.3% in Q3. Those were the strongest consecutive quarters of growth since 2021 before the start of the Fed's aggressive hiking cycle. A combination of resilient consumer spending, a surge in AI related infrastructure investment, and a reversal in trade flows, rising exports and slowing imports drove this rebound. So what this does is this data really reinforces the hopes for a soft landing, but it also highlights how shifts in trade policy distorted headline growth from quarter to quarter. Q1's headline growth was weak because of imports surging ahead of expected tariffs and price increases, but Q3 was boosted by a rebound in exports and fewer imports as businesses work down their pre-tariff inventories. So stripping out these swings and really underlying economic growth appears more stable than these swings would suggest. And so this is really suggesting that the core of the economy remains solid. There's a potential for the economy to continue expanding as the Fed's late 2025 rate cuts unlock activity that was delayed by high interest rates in recent years. Now, what I want to talk about here is an update on the labor market. So this is showing us the labor market and post-pandemic hiring surge continuing to fade. Starting on the chart in the upper left, monthly job growth has slowed sharply since early 2021. After consistently adding hundreds of thousands of jobs per month during the early stages of the recovery, hiring normalized in 2023 and 2024. The pace of hiring then slowed further in 2025, and it's even turned a little negative in multiple months. So the chart on the upper right side graphs the year over year growth of employed individuals, and this is reinforcing this trend. Employment grew around 5% year over year in 2022 as companies rehired and expanded during the pandemic recovery. However, over the past couple of years, the growth rate of the employed individuals has steadily slowed, falling all the way to 0.6% in late 2025. The top two charts show the labor market is still adding jobs and growing, but at a much slower pace, which suggests that the labor demand is softening. The chart in the lower right gives us a little bit more context. I know it's kind of a weird chart, but I like it because it graphs the monthly pace of new hires and layoffs/discharges. In 2021 and 2022, hiring activity was strong, layoffs were low. Since then, hiring has cooled while layoffs and discharges have gradually increased. The combination reflects what economists are calling a low hire, low fire labor market, where employers are hesitant to add new workers or fill open jobs, but they're also reluctant to let existing staff go. Now, these dynamics are starting to show up in the unemployment rate, and you can see that in the lower left-hand chart. Unemployment bottomed out around 3.5% in early 2023 as companies were hired in a tight post-pandemic labor market. However, the unemployment rate steadily climbed from 2023 to 2025 and rose to 4.6% in Q4. That was the highest since 2021. While unemployment is still relatively low by historic standards, the upward trend signals a turning point in labor market conditions. So the job market remains tight. You see this as evidenced by the low hiring, low firing backdrop, but it's starting to soften. Job growth is weaker, unemployment is rising as some workers return to the labor market. This combination is what's caused the Fed to cut rates multiple times in the second half of 2025, and the labor market is going to remain a key focus moving forward through 2026. So this is looking at the impact of federal policy, like the Federal Reserve policy, over the past few years. It graphs the effective interest rate on all outstanding mortgage debt, which represents the weighted average rate households are paying across the entire mortgage market. So this is an average. You're going to have some folks that were a little bit higher. You're going to have some folks that were a little bit lower. But I think it's nice to look at it from an average standpoint. So the effective mortgage rate moves much more slowly than the headline mortgage rate. Most homeowners, they're actually going to keep their mortgages for years. So even if mortgage rates spike like they did in recent years, the effective rate rises gradually as old mortgages are paid off or refinanced and new ones replace them. So you can see this in the chart with the effective rate falling steadily in the 2010s as interest rates remain low. It dropped all the way to 3.3% during the pandemic as Fed cut rates almost to zero. Mortgage rates plummeted. Homeowners decided to refinance to lock in those low mortgage rates. During 2022 and 2023, the Fed aggressively hiked interest rates, with the rate on new mortgages rising to almost 8%. Now, while many homeowners were locked in at low rates, new borrowing occurred at much higher rates. This has pushed the effective rate on outstanding mortgages to 4.2%. That's the highest going back to 2012. This trend is likely to continue, even though headline mortgage rates have fallen as the Fed cut. They're still sitting above 6%. And this means the effective rate is going to continue to rise as older, cheaper loans roll off and they're replaced with more of those higher rate mortgages. So the chart is really showing how monetary policy and the Fed's actions work with a lag. Even if the Fed continues to cut, households are going to continue to feel the impact, the impact and the effects of a tighter monetary policy. The impact could be weaker consumer spending, less household demand, and slower economic growth. The market and the Fed will be watching closely in 2026 to try and gauge that overall impact. So let's take a look at the S&P 500's rolling 10-year annualized return going back to 1935. I love history. Previous things are not always an indication of what's exactly going to happen in the future, but I do think when we understand how we got where we are, it can help us understand where we're headed, right? So each point here represents the annualized return for an investor would have earned, assuming they bought and held the S&P 500 for a decade. So what this approach does is it smooths out some of the short-term volatility and shows how long-term economic and market trends help shape investor outcomes. So this chart shows a clear cyclical pattern, and you're going to see strong returns often followed by periods of weak returns. The first peak occurred in the 1950s during the post-war boom. The market delivered a 10-year annualized return of 15.3%. This was driven by the U.S. rapid industrial expansion, consumer growth after World War II. Everybody was buying those Studebakers, which I think are a super cool car. Never gotten to drive one, but I'd like to someday. Second peak occurred in the 1990s, and that was during the height of the tech and the internet boom. The market generated a 10-year annualized return of 16.7%, and that was driven by technology stocks, falling interest rate, globalization, and a decade of strong economic data. The chart shows that period of extended strength, like the 1950s and the 1990s, were often followed by underperformance. The 1970s, the early 1980s were marked by stagflation, while the 2000s included the dot-com bubble and the 2008 financial crisis. During these periods, the market's 10-year annualized returns fell and even briefly turned negative, illustrating how periods of strength can lead to mean reversion in the stock markets. Now, the far right shows the most recent peak, with the S&P 500 delivering a 10-year annualized return of 12.8% over the past decade. This period started with low interest rates and easy monetary policy following the 2008 financial crisis. It saw the rise of mega cap US tech companies and AI and included massive COVID stimulus. The S&P 500 ended 2025 with a nearly 18% gain, its third consecutive year of double-digit returns, and over the past 5 years, it posted an annualized return of over 16%. So looking ahead, the bar is higher. Today's starting point is very different than a few years ago or even last year. Stock valuations are expensive, credit spreads are near the tightest levels in decades, and expectations for earnings and economic growth are high. None of these are red flags on their own, but they frame the current market environment. The tech sector is undergoing a wave of innovation that hasn't been seen since the 1990s. Corporate earnings are strong, the Fed is cutting, and economic growth is solid. The market strength does not necessarily signal a sell off, but it leaves less room for positive surprises. So let's talk about some different key themes to watch over the next 6 months. These are themes that we believe that can impact how markets trade in the first half of 2026. The first one is the state of the economy heading into 2026. A 43-day government shutdown, it really disrupted the release of some of that key economic data. That left policymakers as well as investors with an incomplete picture of recent economic conditions. Government agencies are clearing the backlog, but some reports have been delayed significantly. Others have been straight up canceled. Early data that has been released suggests the economy remains stable and mostly unchanged, but the lack of timely information makes it really difficult to assess the economy. So, as more data becomes visible and available, the focus is going to be on how the economy ended the year and where it settles in early 2026. The second theme is really around the continued build out of AI infrastructure. Companies across the technology ecosystem have announced plans to spend trillions of dollars to build the computing power, data centers, energy capacity needed to support AI. This investment has been a major driver of corporate earnings, economic growth, and stock market returns. The question is how these spending commitments are going to be financed, and a large portion likely needing external financing. So investors are going to be watching to see whether the market remains willing to fund the build out amid uncertainty amongst the return investment. If the focus shifts towards profitability, returns on investment, and cash flow discipline, it could slow down the AI industry and impact the stock market significantly. Now, the third theme is whether the housing market is going to continue to fall. Mortgage rates have declined as the Fed cut interest rates, which has eased pressure on new buyers, and housing inventory is rising as new listings are coming to market. Home price appreciation has slowed, though affordability is still remaining a challenge for a lot of buyers, particularly first time home buyers. Now, over the next 6 months, investors are going to be watching to see whether mortgage rates continue to decline and if improved supply leads to stronger housing activity. A sustained improvement in housing would signal that the lower interest rates are beginning to filter through the real economy. The last thing I would say is I didn't put it up here because this is very new, but as we've seen things developing with Venezuela, the impact that the U.S. economy has across the world is felt. Also, the impact from our government and the stance that we've taken on an international stage. It's going to be really key to watch what's coming out of this current administration. I think there is a lot of headlines that are coming out, but the truth is a little bit of a longer play. I think it's important to be cognizant of not just the day to day volatility, but the longer term trends and where things are headed. And I hope you see that in every crisis, there's an opportunity. In many opportunities, there's also a crisis. And so it's really going to be key that you maintain discipline, that you have a risk profile that you're comfortable with, that we remain diversified across asset classes, domestic, international, and that we're just balanced appropriately across the board. So if you have questions or if you're concerned, if you're worried about the market situations, or if you just want to talk about more details, you are welcome to reach out. Thank you so much for joining us today. I hope this webinar has been insightful. I hope you enjoyed the market themes that our team is following as we work hard to manage your family's wealth alongside our own. So if you have any questions, you can always reach out to the team. You can contact us at the office, and we look forward to seeing you soon. I hope you have a wonderful day. I've got some really cool definitions up here if you want to read them. They're always fun. And then my favorite part, disclosures. Gotta love it. Y'all have a beautiful day. Take care.